All right, good morning, everybody. Hope you're doing well. Let's go ahead and begin. First of all, with a couple of announcements. Monday, there's no class because it's the Labor Day holiday, and so you have a well-deserved break there. Oh, hold on a second. All right. And then the other announcement, I wanted to remind you that the next homework assignment, which is available now on Blackboard, the PDF is posted there. That assignment is due on Friday the 11th. So before we start talking about the idea of minimum attractive rate of return, are there any questions related to the announcements? All right. Here is a table that summarizes what concept we saw in the lecture on Wednesday. Remember that one of the ideas introduced on Wednesday was the concept of the difference between the nominal interest and effective interest. And nominal interest is when you are quoting an annual interest rate without taking into account the effect of compounding. And remember that sometimes there may be instances where interest is only being compounded once per year, but there can also be other cases where an interest rate which is quoted on an annual basis just for convenience is actually being compounded more often than annually. And so what this table illustrates is as you have gradually increasing interest rates, how the difference between nominal and effective interest kind of diverges. And so, for instance, if we look at 6% interest, the 6% interest, if it's compounded annually, then the nominal and the effective rate is the same. Remember, we saw the formula last time. I effective is 1 plus r divided by m to the m power, that formula that allows us to calculate the effective rate. And so if m is 1 in that equation, then the nominal and effective are the same. And if you have a higher interest rate, so here starting with the nominal rate of 24%, then the effective for daily compounding is going to be 27.11. So that's quite a bit higher if you have the more frequent compounding. So the take-home lesson from this, the concept is that the larger the interest rate, the greater the effect is going to be for the more frequent compounding. So at 6%, the change in interest between annual and daily compounding is only 0.18%. But if you start out with a greater base rate, if your nominal is higher, then the difference between nominal and effective will also be higher. A lot of people joining late today. I'll remind you that you missed the announcements if you don't join into the class right on time. And so if you ever find yourself losing track of what's due and the announcements and so on, please be sure that you join the class on time. Okay, so higher interest rate means that there's going to be a bigger difference. And number two, the increasing frequency of compounding has a decreasing effect. So if you look at, first of all, the difference between annual and semi-annual, if you compound twice per year, then the change in interest from 25.44 to 24 is only 1.44%. But then if you go from 6 to 12, then the change isn't as pronounced as that. And so there's kind of a diminishing returns where if you had hourly compounding and compounding every minute or compounding every second, then it kind of ceases to be important. It's approaching some maximum value. The effective interest is. All right, so you may remember this figure from before. And if you do, does somebody recall why you have an increasing interest rate for a company that's borrowing more money? That's what we talked about in our previous time that we saw this figure, is the figure is all obviously going up. And so what that means is that if a single company wants to borrow $8 million, they're going to pay a higher interest rate than if that same company only wanted to borrow $2 million. And so what was the primary effect that I talked about as to why the interest rate is higher? I think I hear somebody's microphone open. Or is somebody going to answer?
Yeah, I'm trying. All right. The reason why is that from the bank perspective, it may look as if the company is might be like closing or failing because they're needing more funds, basically.
Okay. So the bank is perceiving that maybe the company is in trouble. Calvin
Yeah,
mentioned,
they're not going to be able to get their investment back.
okay, there it is exactly. Calvin mentioned risk, and you've just mentioned that they may not get their investment back. And so the risk, the specific risk that the bank is worried about is default. So default risk means that the lender won't be able to repay. And so if the bank perceives that there's more risk, then they're going to want a higher rate of return to compensate them for that risk. And so that was the refresher of what we talked about before, is that the more a company wants to borrow, the more expensive it's going to be for them to borrow the funds. Okay, now I'm going to add some additional figure on top of this. And so it's going to be two concepts overlaid on top of each other, and we're going to talk about the equilibrium point between those two concepts. And so far what we're talking about is the relationship between the amount borrowed and the risk of non-payment, and that's from the perspective of the bank. Let's say that your company is faced with some possible projects. Let's say that your company maybe could choose to upgrade its computer networks, buy new trucks, remodel the loading docks. There's just a list of all of these possibilities, and each one of them has the potential to give you more revenue. Or they could save costs that previously you were incurring. And so, maybe upgrading the computer networks is going to make it possible for you to get a new contract. But the security cameras, maybe that won't be important for getting that new contract, but maybe it will help your company to experience less theft than it's been having before. So it would be an investment, and in the future you'd save money that you used to spend or lose due to theft. And so let's say you have all these possible projects that you can do, and we analyze these projects to find out what kind of a rate of return they would give us. That is, if you borrow a certain amount of money to buy the upgraded computer network, what rate of return you're going to get is talking about on an annual basis how much of that original investment is coming back to you in additional revenue or sales. So what we do is we take these possible projects and we analyze how much does it cost and what's the return on investment. And then we graph that on top of our earlier diagram of risk. And so remember that option A was upgrade your computer network. And so you can see that in this case, the cost that we've estimated is the width of the bar. And so down on the horizontal axis, we have tick marks that indicates $1 million, $2 million, and so on. And so it looks like option A has a cost of about $600,000. And so to upgrade the computer network, you're spending $600,000, and then the return on investment for that is 35%. Option B is more expensive, buying new delivery trucks. And we know it's more expensive because the bar is wider. It looks like it's going to be about $1.4 million for those new delivery trucks. And it also doesn't yield the same rate of return. It only yields 30%. So when we're constructing a figure like this, we prioritize the projects that have the highest rate of return. And so you can see that it's sorted from the highest project on the left, and then the next highest project, and so on and so forth down the line until we get to the security cameras project. That was project G, and it only returns 14%. So projects A through E all share the common characteristic that their rate of return is greater than the borrowing cost. And if we were going to do these projects, if we were going to finance them by borrowing money, then all of those projects would be acceptable. And let's think about what's the decision criteria. For example, with project A, if you have to go borrow money from a bank, and the bank says that you have to pay them 10% interest, but you know the project is going to give you a 35% rate of return, think about, does that project make sense? And should you do a project where you have to pay the bank 10%, but you receive 35%? Well, absolutely that makes sense. I mean, it's almost as though, what if you could borrow money from Fifth Third Bank and then deposit that same money that you borrowed at Chase Bank, and Fifth Third was only going to charge you 10% interest for the loan, but Chase Bank is going to pay you 35% on the deposit. You should try and borrow as much money as possible to make that deal, because you get to keep the difference. The difference between the 10% that you're paying to Fifth Third Bank and the 35% that you're receiving from Chase Bank, that differential is the profits that you get to keep. And so earlier I used the phrase decision criteria, and I'm going to say that phrase a lot this semester. This course is largely about making decisions, and economic analysis is driven by the need to pick from alternatives and know how to spend your money and which projects should be done. And so should you do project A? Yes, you should do project A, because the rate of return is higher than the borrowing costs. Should you do project B? Yes, because the rate of return is higher than the borrowing costs, and so on and so forth. But now let's look at project F. Project F is rejected, as you can see from the figure. And the reason why we reject project F is because the borrowing cost isn't greater than the rate of return. So by the time we have borrowed so much money, we've already done our top priorities, and now the bank is starting to get nervous because we've borrowed so much money. They're beginning to worry that there may be a default risk. And so to get from $6 million borrowed to $7 million borrowed, the bank says, well, at this point, we want 16%. And then we look at the project we were going to do with that extra money. Project F is only going to give us 16% rate of return. And so you wouldn't do a project if the bank was going to keep all of the profit. And that's exactly what's going to happen. If you undertake project F, the rate of return is 16%, and the borrowing cost is 16%, and so we reject the alternative. The decision criteria is accept the alternative if the rate of return is higher than the borrowing cost. Now here, MARR, M-A-R-R, that means minimum acceptable rate of return. And one of the things that can determine for your company what's the minimally acceptable rate of return is how much it costs you to borrow money. That's one of several factors that can go into determining that interest rate. And so our company, in this example, is setting the MARR equal to the borrowing costs, the approximate cost of capital obtained. So the supply of money is how we decide what to set as our MARR. And project G is even worse than project F. You know, in the case of project F, at least you are going to be making enough money to pay back the bank. But in the case of project G, if you borrow that money, you're actually going to be paying the bank 16 or 17% interest, but you're only receiving 14% interest. And so you're losing money on that deal. So that's why they're rejected. So this is a really important slide, and sometimes on exams I'll ask you to either draw a picture to illustrate a concept or to interpret a diagram that I provide during the exam. And this is one of the figures that oftentimes in previous exams I've asked students to explain. And what I hope you'd be able to explain with this figure is how it illustrates when to accept and reject a project. And the decision criteria that this is illustrating is that if the rate of return is higher than the MAR, accept a project. But if the rate of return is equal to or less than the MAR, then you'd reject the project. So any questions about this diagram?
So what about if we're like in the very beginnings of our company and our MAR is say 16% and we need to take out a loan at 16%, but it's for a very necessary function like paying my employees' pensions or things like that?
Well, there are some companies that lose money in the short term, and that's part of their strategy. I think earlier in the semester I cited the example of Amazon that was, I think it wasn't profitable for the first 12 or 13 years of its existence. And so there are cases where you don't have any alternative but to accept losses in the short term. But in a steady state situation where you are a company that's trying to make profit, then you can't accept a project that is going to cost you more money than you receive to undertake it. So the typical decision criteria is going to be to reject an alternative where the rate of return is lower than the minimum. And if you're just in the starting stages of your company, then that maybe would be reflected in your minimum acceptable rate of return. You know, like if you're just being incubated, then maybe your minimum acceptable rate of return is 1%, which is lower than your borrowing costs. So does that answer your question?
If I may,
Hello? Go ahead.
if I may, Dr. Waite, I know when I worked for a gas company and a earth moving company was trying to get our work to do well locations, a lot of times they would do it where they broke even just because they knew later on doing the work they would get the work from us.
Yeah, so it would be an investment in the future, and there are other considerations just beyond the profitability of that one particular project.
Would it make sense to reject E since it's borderline to basically reduce the amount that you're having to pay in interest? You're reducing the capital that you're borrowing, so you're reducing the interest to make more on the other projects?
Okay, so that's an important question. What about Project E? Project E isn't as attractive as all the other projects. I mean, it's certainly not making 35% or 30% or even 23%, but right now, today, if there was a bank here in town that would pay me 19% and another one that would loan money at 14 or 15, I'd still take that trade. You know, it's better to get some profits than no profits. And so if you don't do Project E, then you don't get the profit associated with that undertaking. And so I think that if we look at just the increment, just at what E is doing, it's still a favorable project, and so we should undertake it according to our decision criteria. All right, so let's look at some of the details behind MAR. I earlier said that borrowing cost is a really important factor in determining what you set as your minimum, but that's not the only factor. Here at the top, it says that the minimum acceptable rate of return, sometimes also called the minimum attractive rate of return or the hurdle rate, it's a policy decision. And the executives in a company will make the decision of what they're going to set as the minimum acceptable. And it may be changing from year to year if they're trying to attract new business, or if they are in the early stages and can tolerate losses because they have investors who will sustain their operations in spite of losses. Part number one is just summarizing how much money you've got for the projects and how much it cost you to get the money. And so weighted average cost of capital is the borrowing costs. And banks aren't the only place you can go to raise money for a project. There's also private investment. There are selling bonds. There is selling stock or preferred stock in your company. And we'll talk more about each of those options and how they vary. And then later in today's in-class exercise, we'll get some practice on calculating the weighted average cost of capital. Sometimes where to set the MAR is driven by how many projects you've got and the types of projects and what is the purpose of the project. And so a particular company, if they perceive that they may get a lot of good publicity for a project, maybe even though it's not as profitable as some of the others, they may be willing to accept a lower MAR for that project than otherwise they would. And so this is already telling us that there can be other factors besides just the borrowing costs that influence what we set as the MAR. If a construction company is going through a slow period, and maybe last year there was so much work and so little competition that they could have a really high expectation for the profitability of the projects they sign up for. But then there's maybe an economic recession or a pandemic or something, and now suddenly there's less work and more people looking for it, then that's going to reduce the MAR for that company. They're going to be willing to accept a lower rate of return than they may have in the past. There's also this consideration that's called opportunity cost. Opportunity cost is the value of the second best alternative that you have available. And you can apply opportunity cost to a lot of different concepts, a lot of different applications. For example, right now you're listening to this lecture, but you could have been doing something else. You could be sleeping right now. You could be working on a homework assignment maybe that's due at 5 o'clock or whatever. There's some other thing that you could have been doing. And so beyond just the direct cost that you paid in tuition to participate in this class, you're also experiencing an opportunity cost, which is the things you can't do because you're spending your time here right now. So in the case of a company, what they set as their MAR depends on partly which projects they have to say no to. If they are choosing one project, they can't do everything at the same time. You can't be everything to everyone. And so, during that economic recession, maybe the opportunity costs are lower because you don't have other alternatives. And so that causes you to lower your MAR. But then during good times, the opportunity costs are higher because if you're doing one thing, then that means you have to say no to all these other great opportunities. Of course, risk is another consideration. And so if a company is facing a lot of risk that maybe a project is speculative or the revenue that they could get from doing a particular project is uncertain, or the cost of administering a project is high. Maybe if you're doing a project for the federal government, for example, there's just so much paperwork and you have to jump through so many hoops, then they may want a higher rate of return for projects done for the government than if it's just a private payer, someone who's just going to write a check for the work that gets done and doesn't insist on so many forms being filled out. So risk and administration costs. And then also MARs vary a lot within the different types of organizations. A public utility that's owned by a municipality, let's say a municipal water company. And so if the water company that's operating in Parkersburg wants to do a project, they may not have the same high expectations for profitability than if it's a privately owned company, where they have a profit motive, and so nonprofits like a hospital or government agencies would maybe have lower expectations for a rate of return as well. So there's lots of different places you can go to get money when you're trying to finance projects, and one of them is by taking on investors who are going to become part owners in the initiative with you. Equity financing is what we call it when you sell shares in your company, like stock. If you own stock in Tesla. That means you're a part owner of the company. And what you get from owning those shares is you are claiming a portion of the future profits. Not only do you own your share of the equipment and the real estate and the machinery, you do have a share of their assets, but you also own a share of their future revenues. And so that's equity. So one way you can raise money for a project is by selling shares of your company. Another way is just to borrow money. And debt financing is different from equity financing because in the case of equity financing, it's not like you have to pay back your shareholders a certain fixed dollar amount. It's just they're in the same boat with you, and if the company succeeds, they succeed. If the company fails, then they don't get their money back. It's not guaranteed in equity financing. But debt financing is generally secured by some sort of collateral, and you're promising to pay back a certain amount. So if Tesla takes a loan from a bank, then they're going to tell the bank exactly how much they'll pay the bank back, when the bank is going to be paid back, and there's a negotiated interest rate for that loan. And so the upside is that it's secured. The downside from the perspective of the person loaning the money is that, if the company does really, really well, the bank doesn't get any more money than they are legally entitled to. They don't share some of the unlimited potential for the upside. Here's the decision criteria, is that a project isn't economically justified if the rate of return isn't at least greater than or equal to the minimum acceptable rate of return. And the minimum acceptable rate of return should be greater than your borrowing costs. And the weighted average cost of capital is another word for borrowing costs. And so there may be other things that justify a project. You may be justified because of the public relations value, because you want to grow your market share someday in the future. But for now, a project is only economically justified if it's going to be profitable. And this is the decision criteria for that. These are the rules that you apply. And so, earlier I told you about exams, how I sometimes will just show a picture and I'll ask you to explain the picture in an exam. Another thing I like to do is I like to ask, what is the decision criteria for a certain kind of decision? Like, what are the rules that you apply to know whether you should, yes, accept a project, or no, reject the project? And so here, the decision criteria for a rate of return analysis is that the rate of return should be greater than or equal to the MAR, which is greater than the weighted average cost of capital. So you should begin kind of circling these rules when I show them to you, because these rules or the decision criteria are really important. So opportunity cost. I saw this headline on a website a couple of years ago, and what it was talking about was a high school in New York City where people can graduate from this aviation program within the specialized high school and within 3 years be making $70,000, because this high school, they get kind of like a baseline certification. And then after 3 years of experience, they can get like the formal licensing that allows them to be like a supervising mechanic on a certain kind of airplane inspection and refurbishing. And then $72,000 a year with a high school education and 3 years of experience. That sounds pretty good. So what are we doing in college if you could be making 70 grand outside working on planes? So this is an illustration of opportunity cost if you live in New York City. I mean, I don't think that there's an aviation program at the high school level like this around here. Chasing our dreams, absolutely. You don't want to be working at an airport. It's cold there and loud and smells like jet fuel. Here's another illustration of opportunity cost. This headline is from 2019. Walmart is hiring truck drivers who can make nearly $90,000 a year. Now, I don't think every truck driver they have is making $90,000 a year. That's probably like with lots of experience and lots of overtime, but it's just an illustration of opportunity cost. There's always something else that you could be doing besides the thing that you are doing. So it's not just the direct costs that you have to consider. It's also the value of your second best alternative. So that is opportunity cost. It's the largest rate of return of all the projects that you didn't accept due to a lack of capital funds. And so if you can't do a certain project because you don't have the money to borrow it, you can't borrow the money to do it, then that's your opportunity cost. So let's say that your minimum acceptable rate of return for your project, for your company is 10%, and you can't do project A because you're not able to borrow enough money to do it. And project B is 15%, and it's funded because it costs less than project A. So your opportunity cost is the value of the project that you couldn't do because you had a lack of funds. Okay, here's a formula. This looks complicated, but it's really, really easy. It's a weighted average. And this weighted average is used for determining the weighted average cost of capital. And so if you get some of your money from a bank, and if you get some of your money from selling bonds, and some of your money from issuing stock, you'd want to find out the average. And a simple average for three different things would just be add them together and divide by 3. That's a simple average. But what a weighted average does is it takes into account how much money you borrow from each particular source. And so, if you're getting most of your money from one location and just a little bit from the others, then it wouldn't be reasonable to add them together and divide by 3. The simple average would give you an unclear idea of how much your cost of capital actually was. And so this is one of the formulas that we're going to use in today's in-class exercise. All right, so let me bring that up on the screen. I hope by now you've printed those in-class exercises out. Here is the in-class exercise for today. First of all, kind of a concept question to get you to think about opportunity cost. And then question 2 is addressing whether you should thumbs up or thumbs down on A through F. So the table on the right summarizes borrowing costs. And what I'd like you to do in question 2 is to consider each of the projects and apply the decision criteria. So remember, I've already talked about decision criteria and what that means. So problem 1, just briefly write down what is your opportunity cost for attending the university, and then problem 2, identify go one by one. Each one of these projects is either a yes or a no. All right, so answers are going to vary for answer number 1. Maybe for some of us, the opportunity cost would just be like a minimum wage job. And, it's hard to have a great paying job. There aren't as many nowadays where you can go straight from high school into a high paying career. There maybe are a few, but not as many as there used to be. And so in question 2, let's look at the analysis here of which project should be undertaken. So it says here that your company is AA rated. And in the table, what it's showing is that different companies borrow money at different interest rates. So the 5-year maybe shows it well. A AAA rated company can borrow money at 1.94%. And rating agencies look at how long a company has been in business, how many orders they have in their order book, their assets. And so they essentially are independent companies that assess risk. And so a company that has a AAA rating is assumed to be very low in risk. And so that's why they're able to borrow money at a lower interest rate than, say, just a single A rated company would have to pay 2.51%. So should we do new delivery vehicles? It's going to be a 5-year project and will return 9%. Well, it says here, yes, we should do project A. And the reason why is our borrowing costs are 2.22% and our rate of return is 9. So that's a great exchange. Project B, though, is a no, because you're only going to earn 1% and it will cost 1.32. So the decision criteria says reject option B because the cost of capital is higher than the rate of return. So project B is terrible. It's a no. Project F is also a no. Project F, it's a 10-year project. It will return 3% but would cost 3.26%. Okay, any questions about that first part? All right, so the last two questions in today's in-class exercise. Okay, a question to go over it again. Yeah, let me bring that back up. So we already talked about A and B. C is a yes because it gives 3%, but the cost of a project for a 5-year term is 2.22%. So that's why we say yes to project C, is the rate of return is greater than the cost of capital. Same with project D, which is a 10-year project. It will pay 3.5, but you only have to, the interest on that is 3.26. And so the return on that project exceeds the borrowing costs. Same with E. The borrowing costs.
How do you, how do you determine the rate of return on something like computer hardware or computer software?
Well, in this course, you'll always be given assumed rates of return. But some of the ways that they do it in the real world is they'd look at past projects. Maybe, it's not the first time they've made an upgrade and they know what kind of productivity they had last time they made a similar upgrade. It could be information that they get from whatever vendor is trying to sell them that stuff. Like a salesman for a computer hardware company, like in a corporate environment, they're going to say, here, I want you to buy this, and they're going to have a proposal that's going to show how much more productive your company is going to be. So it could be based on information you get from the vendor. Sometimes an accounting department would have access to industry databases, and those industry databases will have typical costs of supplies and also maybe market research or case studies that showed how productivity changed or sales improved. So there's no one simple easy answer that's always going to give you 100% accurate estimated rate of return. Sometimes it's speculative, and so sometimes you would maybe hope that a project doesn't give you 8%, but maybe you'll say, well, let's assume it's going to only yield 6% to be on the safe side because I'm pretty sure it'll give 6%. That estimating what is going to be the rate of return is as much an art as a science.
Okay, and then would you be able to also add into the fact of if I purchase these new computers and something were to go wrong, that I would be able to resell that item and like the value of whatever that item's resale value is, have a playing factor into the rate of return?
Mm-hmm. Yeah. In a couple of weeks, we're going to be calculating these rates of return from a cash flow diagram. And you maybe remember from Wednesday's class that we had salvage value on one of our cash flow diagrams that was constructed. And so yes, you can put the resale value or the salvage value of equipment into an estimate like that and incorporate it into the rate of return.
Okay, cool.
Okay. So now, what might be some factors that influence the interest rate a company pays to borrow money? So think about what different things is a bank going to look at when deciding how much to charge a company to borrow money. So I'm going to pause and let you list some numbers, list some things there. I'll bring up my list in a moment. And also try and solve this. And I'm going to refer back to the formula that I showed you earlier. Let's see. No, I don't think I can. Well, maybe I could do this. Print screen. Okay, back to the in-class exercise. All right, so try and solve 3 and 4. Range of possibilities. So the bank is charging 6.5%, corporate bonds 4.5, and these dividend payments is 7.8. And so the average is going to be somewhere in the middle between 4.5 and 7.8. It can't be any higher than 7.8, and it can't be any lower than 4.5. A simple average would be to simply add together 6.5, 4.5, 7.8, divide by 3. But if you've done that, it wouldn't be taking into account how much money you got from each of the sources. So let me, because we're running low on time, bring the solution up on the screen and show you both of these. Okay, so question 3, some of the factors that a bank is going to look like when it decides how much to charge a company for a loan. How long has it been in business? Number of customers it has, the number of projects it has outstanding, how much revenue. These are all going to be indicators of the default risk. And remember, the main risk that the bank is worried about is that the person may not pay them back. And so default risk is the chief concern. And so think about the underlying factors that could contribute to default risk. Other factors, have they defaulted before? That's a huge red flag. All right, here's the weighted average. So it's saying that 25% of the money that's borrowed, now I think maybe in the formula that I showed you, it said to do percent of A, and here I've done it as a decimal. I kind of did a shortcut where if you do it as a decimal, then you don't have to divide by 100 in the end. But it's going to be 5.99% because a quarter of it will be 6.5%, 45% of the money you borrow. You're paying 4.5% for that. And then 30% of the money that's borrowed is going to cost 7.8%. And so the weighted average should be 5.99%. All right, well, that's it for today. Let's revisit these announcements. Remember that there's no class on Monday. You're going to be taking a rest from your labors and enjoying the holiday. We'll be back together on Wednesday, of course. Homework number 2 is due on Friday the 11th. And now we've already covered quite a bit of the topics for that assignment. Cash flows, check. Compounding, check. Minimum acceptable rate of return, check. So you should maybe spend some time over the weekend getting a head start on the assignment. And if you have questions, you can send me an email, call me on Teams. I'll do my best to respond. I do have office hours after this class, but I'm headed across the street to go speak in Engineering 103. So I won't be able to pick up if you call me immediately after this class, but I will be in the office through the rest of the day. So get in touch if you need to, and have a great weekend. Take care. Bye.